Good morning, everybody. We have a lot to cover today. I was just kind of rambling as I was starting this webinar, but welcome to the fourth session of this webinar. If you've been with us through all four, you know that we have covered business interruption, followed by the workers' comp, the directors and officers, and particularly we covered the insurance aspects of those and any legislation that would change any of the coverages or how states and insurance carriers are approaching those three different coverages. Today, Chris Jacobs is on the webinar again. Most of you are familiar with him from Houston Harbaugh. He is going to be updating. It's a quick update on any of the legislative changes. I'll let him get into that. But the focus of today's webinar is going to be around maximizing the PPP loan. And with that being said, we have Brian Matthews from Schneider that's going to go over that information with us. A little background on Brian. He's a senior manager, the business advisory services at Schneider. He's been with the firm over 13 years. And in the past several weeks, he's the expert around the PPP loan at Schneider. So him and his team have been working diligently to track the changing landscape that most of us have been living in as pertains to the PPP loan. And him and his team on a broader focus have been focusing all around the whole federal financial assistance program. But again, today we are going to be focusing just on the PPP loan portion of that. So without further ado, with all the stuff that we have to get into, I'll hand the mic over to Chris to talk about any legislative changes around the coverages.
Thanks, Brandon. I appreciate it. And you know, as Brandon said, we have a lot to cover today, and you know, really the focus is on the PPP loans, and I don't want to take away from Brian's time. So I really don't have any legislative updates. And for those of you who have been tuning in every week, you might be surprised I don't have a whole lot to say, and I don't even have slides, but I did want to just provide you just a brief update of where we are generally on business interruption. The litigation, flurry that we saw initially has tapered off. Most of these cases are in the procedural phase now. There's a battle regarding whether these cases should belong in federal or state court. So we're dealing with a lot of the jurisdictional issues there. Some motions to dismiss have been filed at the federal level in those cases that are filed there and have stayed there. We've yet to see any substantive decisions from any courts yet on any of the legal issues that we previously discussed on the business interruption claims. From a practical standpoint, if you are submitting or developing your business interruption claim, recall that the coverage is limited in time by a defined term in your policy, which is the period of restoration. That begins after a waiting period, which, if you recall, in our first session, I kind of described as a time deductible. Usually it doesn't start until about 72 hours after the business interruption begins. Importantly, it ends when the insured property should be repaired, rebuilt, or replaced to a condition that permits occupancy and use. So should be is important. The reason I mention that is because as we in Pennsylvania transition into the yellow phase and certainly into the green phase, you can imagine that insurers are going to want to shorten the period of restoration for their insureds with respect to their claims. So they will certainly argue that your business should be opened maybe in the yellow phase, but certainly as of the entry of the green phase. So keep that in mind as you're gathering information in connection with the submission of the claim, developing that claim, that's probably going to be viewed as the cutoff point. Be mindful of that as you develop the claim. Then thirdly, if you do recall from our initial discussion on the business interruption, in some policies, payroll expenses are considered in the calculation of what net business income is under your policy. And I think that's a good transition because the PPP loans, I think, will be an important factor in determining that, how that's going to fit into the policy, how insurers are going to treat that in relation to the business income definition remains to be seen. Certainly, uncharted water for us, but that should also be an important consideration and important component of the net business income calculation under the policy. So just a couple of things to keep in mind, but with that, I'd like to turn it over to Brian so we can get to the principal portion of today's presentation. So thank you.
Thanks, Chris. So it's a good segue into our topic of the day of the Paycheck Protection Program loan forgiveness calculations. Based on kind of where things are, many businesses have been interrupted and many organizations have applied for this paycheck protection loan. And I'd just like to start off by saying thanks to Seubert and Associates for having me to present on the program, and thanks for their weekly series on some important topics that provide their clients with helpful insights. I'm Brian Matthews, a senior manager with Schneider Downs in the business advisory department. If you're not familiar with Schneider Downs, we're a regional accounting and advisory firm with 3 offices in Pittsburgh, Columbus, and DC. We like to think of ourselves as one firm with 3 offices. We are one of the top 60 largest accounting and advisory firms in the United States. We're comprised of 5 different business units that provide more than 80 unique service offerings. And like Seubert, we value our relationship with our customers, and through our own internally developed standards, we're committed to big thinking with a personal focus, and that's really where our kind of dialogue and why we've developed a task force for helping clients with the paycheck protection programs and helping friends of clients with the paycheck protection program loan process. The business advisory group and service department, it's headed up by Joel Rosenthal, and we provide consulting services of a variety, transaction advisory service, business valuations, investigative and forensic accounting, litigation support, and financial modeling. So with that, hopefully by the end of our time together, you have an understanding, a little bit more of an understanding of the Paycheck Protection Program, the eligible costs that are eligible to be used with the loan proceeds, but also what's eligible for forgiveness, because that's really important to know. Many of the borrowers are really looking to maximize forgiveness to make sure that the money's used, is forgiven, and you don't have a loan on the back end. And hopefully for your own sake, you come out with some action items, whether it's something that I've said during this presentation or just Q&A questions that we will have as part of this program. We've specifically and intentionally segregated and put set aside a time for Q&A. So in the bottom of the Zoom window, you should see a chat box. If you have questions, please put them in there. I'll try to address, I'll address as many as I can, and we will hopefully kind of help you develop some action items for yourselves. We'll start with an overview of the program, some loan basics. We'll talk about the mechanics of the forgiveness, and then, like I mentioned, we'll conclude with a question and answer session. A little disclaimer, as Brandon mentioned at the onset, it's a ever-changing environment. Currently, as we sit here today, I'll provide guidance based on what the roles are currently, the regulatory guidance that's been issued. The SBA continues to issue FAQs that provide regulatory guidance. Based on what we know today, I'll be providing insight based on what is available. It's not intended to be legal or tax advisory or other advice. And there's likely going to be updates based on FAQs that are issued after today, or IFRs, I might refer to them as, but they call it their interim final rules. They're the rules governing the PPP program. And also I'll talk today also about some congressional actions that are currently sitting for the Senate for vote too, and what could be some possible changes to this program resulting from that. With that, the Paycheck Protection Program, it was established under the Corona Aid, Relief, and Economic Securities Act, referred to as the CARES Act, which was signed by the President on March 27th of this year. It is administered by the Small Business Administration as well as approved lenders, and in conjunction with the Treasury. And the Paycheck Protection Program was an add-on to the Small Business Administration Acts. It was commonly referred to as the 7A loan program. So the Paycheck Protection Program is another loan program being administered by the Small Business Administration. So you might hear me reference SBA, that's the Small Business Administration. As of today, where we sit, there is still money available to be approved and issued for loans. $510 billion is currently been issued to about 4.5 million loan borrowers, and that is of over a $600 billion available appropriation that is based on both the initial CARES Act as well as an increase in the appropriation availability after the initial signing of the law. There's been about 15 different IFRs, interim final rules, that the SBA and the Treasury have issued. So a lot in those. The most recent was issued relative to the forgiveness calculations. There was a lot of speculation, uncertainty on how the calculations would be done, what would be eligible, what would not be eligible. So that was issued about a week and a half ago. Also, throughout the process, from the time that the SBA issued their initial interim final rule, there's been 48 different FAQs issued through the May 27th. So they're really issuing almost a Q&A every day, it seems, to provide borrowers and lenders a little bit more clarity on what the rules are and how to apply them. To be eligible for a PPP loan, there are certain size requirements. Like I mentioned, it is a program under the SBA's Small Business Act that the size requirement is 500 employees based on a certain time period over a 12-month period, or it could be that you qualify under the Small Business Concern under the Small Business Act, which includes some other alternatives. Like there's the alternative to qualify that under the capitalization and net income calculations, which is $15 million of net worth, and the past 2 years net income pre-tax hasn't been greater than $5 million. So there could be organizations with greater than 500 employees that are still eligible for the PPP loan. And we're also approved. There's also a couple exceptions. Hotels were eligible to participate if each location had less than 500 employees, as well as franchises if they had an approved franchise identification number. Independent contractors, that was an important piece of eligibility, and whether if you were an independent contractor, were you to be included with a employer that was hiring you, or should you have applied for your own PPP loan? And the SBA came out and clarified that an independent contractor is required to apply on their own, as well as they've also provided that self-employed employees are also eligible to apply on their own too. The certifications, they have been widely criticized over in news. The most significant one related to the uncertainty of economic conditions and whether or not the loan was necessary. So in the news conference between the president and the Secretary of the Treasury, there was a lot of speculation about some larger corporations receiving funds that they then came out, the SBA came out and the Treasury came out with some guidance over that if you have availability to liquidity, capital resources, it was not anticipated that you would need this loan. Since then, they've added a safe harbor in early May that if your loan is less than $2 million, you will be deemed to have made that safe harbor, that uncertainty certification in good faith. So what that means, though, is if your loan is greater than $2 million, it is still important that you are documenting what uncertainty existed and what your availabilities or lack of availability of resources were. And as we've seen, there's some guidance out, there's a lot of topics and guidance out there about interpretations of what to document, how to document it. So continue to make sure if your loan is less than more than 2 million, you are documenting that. Documentation, you'll see, is going to be very important for this program. The significant terms and conditions of the loan, availability is, excuse me, up to $10 million, but it is limited to 2.5 times your average monthly payroll for 2019 or the most recent 12 months, which typically at the borrower's discretion, and maybe even at the lender's direction, they might suggest you use one or the other. There's some seasonality considerations if you're a seasonal business. There's some additional alternatives. I'll cover some of those as we go throughout this presentation. Also, because of the clarifications on the seasonality, there's also an option for loan increases if guidance was issued subsequent to your loan application and your loan proceeds receipt to increase your loan. And then one of the very coveted term and condition is the forgiveness. And so the terms that allow for forgiveness of loan proceeds to the extent you've used the money that you've received from the SBA to retain and maintain payroll and to make mortgage payments, lease payments, and utility payments. The loan process, it's going to start, the actual loan started with an application for the loan, but the forgiveness process, it's going to start with another application. It will be submitted to the lender. The lender will review it with the accompanying documentation, and I'll talk about what documentation you'll need to submit with the loan. It's going to be reviewed by the lender. They will make a decision on whether you're entitled to full forgiveness or partial forgiveness based on the information provided. They have 60 days to make that determination, and they will need to notify the borrower as well as the SBA on what their decision is. And then the SBA at their discretion also has the ability to review forgiveness applications based on their own process. Eligible payroll costs are to be used in the forgiveness calculations They are to be incurred during the covered period, or if a borrower has a biweekly payroll or a weekly payroll, it really just refers to more frequent. There is an alternative covered payroll period. So that's an important piece to know, because that alternative covered period will simplify things for eligible payroll costs. Because if your loan period starts on April 20th, which is the date that you received your loan, you have a 56-day period that starts on that day, and it will go through June 14th. But what borrowers may run into is issues with timing of their payroll. So the SBA allows for this alternative covered period, which will start with the first payroll after the loan period. So you may have your biweekly payroll starting on April 26th. You'll have all your payroll related items will be for the April 26th period, for this 56-day period after that. Also with the application, an important thing that was clarified was that payroll costs can be incurred in the period and paid after the covered period. So if you didn't do the alternative and you were utilizing the covered period, you likely would have a payroll period that spans to both the covered period and a period not covered. As long as the payroll is incurred in the covered period and paid in the next payroll period, it will be considered to be an eligible forgivable payroll cost. Another item of note to mention is the differences of treatment for categories of employees or owners. Employees, they have their own set of rules with a $100,000 limit. That is, I'll talk about what is included in that. Owner employees, they are treated a little bit differently. They also have a $100,000 limit, but their limit is inclusive of some non-cash consideration. And then self-employed individuals, they have a whole different calculation in that they are limited to their 2019 Schedule C income. So important to note where you fall within the categories, and if as a borrower you have owner employees, it's important to note that they are treated separately so that you are calculating your forgiveness accurately. Eligible payroll costs, it includes cash compensation and non-cash compensation, kind of two categories. Salaries and wages, other similar compensation like commissions are part of that cash compensation. It includes vacation, parental leave, FMLA. It also includes dismissal costs and separation costs, severance. What it does not include are wages that were paid to employees that are subject to the Families First Coronavirus Response Act. So that was a separate act that was passed in Congress that provides borrowers some different type of relief for employees that are taking leave relative to the coronavirus. So important to note that in case you do have employees that are taking leave associated with that. Have to be removed from eligible payroll costs, but important to note there'll be a different type of relief associated with it. So you're not completely lost in that. Non-payroll compensation, it's for the continuation of group health care. So your medical, your dental, your vision. There's no rules right now on the clarity of whether life insurance should be included, disability insurance. Due to the lack of guidance right now, we think it's safer to not include those at this point. Also, retirement benefits are a non-cash compensation that is an eligible payroll cost. You can include your employer costs associated with defined benefit contributions, defined contribution plans, as well as profit sharing plans. And then employer and state local taxes that are assessed on employee compensation. The employer portion may be included as eligible payroll costs. And it's important to note that those three are not limited on the $100,000 per employee. So if you have an employee that makes more than $100,000 on an annualized basis during your covered period, you're able to include those additional types of compensation. There's also eligible non-payroll costs that you can use the loan for, as well as are eligible for forgiveness. They include mortgage interest, rents, and utilities. And the mortgage interest and the rents are only available to the extent those contracts were entered into prior to February 15th of 2020. And for your utilities, it needs to be service locations that were occupied prior to February 15th, 2020. The thought there is that the SBA and the Paycheck Protection Program wasn't looking to fund expansion of organizations. So if you built a new building over the last couple of weeks or entered into a new space, those types of costs would not be eligible for forgiveness. And also another important point that was clarified with the forgiveness application in the most recent rule is the allowing of non-payroll costs to be paid during the covered period or incurred in the covered period and just paid after the next due date. So in another example, if your loan period started on June 1st, you paid your June 1st utilities, and your loan period ended on July 26th, you would be able to include all your your utility costs up to July 26th in your eligible non-payroll costs to the extent they were paid by the next billing period, which maybe it's early August. So it can be paid after that period, but you're only those amounts that are incurred during the covered period. Also, another very highly publicized item of the non-eligible costs is that they are limited to 25% of your forgivable amount. So if you had a $100,000 loan, only 25% of that would be eligible to be forgiven. And that's important to know its forgivable amount too, because if you only used 90,000, then you're only able to, that your $25,000 amount is reduced further. So important to note that it's 25% of the forgivable amount. And so if you used the loan proceeds for all eligible payroll costs and non-payroll costs, that $100,000, you may still be subject to a loan forgiveness reduction. And that is, maximizing loan forgiveness is important for everybody. But there's these certain criteria that you need to meet based on your workforce and your salaries. And so if you reduced your workforce during the covered period, you may be subject to loan forgiveness reduction. And that is a percentage of what you had of FTEs. Now this is an FTE calculation. So it is based on the number of hours worked by employees, not a headcount type of calculation for the covered period, so your loan period, compared to a reference period. And that reference period, it can be in 2019 or it may be in 2020. If you're a seasonal employer, that actually, you have a third option to use May through September, May 1st through September 15th period, and it has to be a consecutive 12-week period. That could be your reference period too. You're using an average number of hours per week divided by 40 hours. That is the established forgiveness hours that the SBA has come out with. There was a lot of speculation early on of whether it was 30 hours, but it is 40 hours based on the application and the rules issued today. You are limited, an employee can be a maximum of 1 FTE. So even if you have an employee that works for you for 48 hours, they are limited to a 1 FTE, even if they're hourly. And you're required to round your calculations to the nearest tenth. But there is a simplified approach. You can use 1 FTE for anybody working 40 hours or more, and anybody working less than 40 hours, you're able to calculate them using a 1/2 FTE. So they've given, as we've seen, they've tried to make things a little bit simpler for borrowers. This is one way to do that. The alternative covered period is another. There are certain FTE exceptions to consider in this calculation. The SBA is not trying to reduce loan forgiveness for a borrower if their workforce was hurt by voluntary resignations or a termination for cause or a voluntary or if an employee voluntarily requested and received a reduction of hours. So it's important to note as you're looking at your loan forgiveness, you're looking at these on an employee by an employee basis, because it could be those types of classifications could impact your loan forgiveness. And also there's a safe harbor exemption that if you hire back your workforce by June 30th, you will not be subject to the loan forgiveness. And I'll show you a couple of the dates on the next slide. And then there's also some, there's an exception to that too. If you made a good faith offer to an employee to rehire them back at the same wage, same number of hours, that should also not impact your loan forgiveness. So here, as you can see, this is from the application, the line 7, it requires you to put a percentage of what your loan forgiveness potentially could be. And in this example, we're using 91%. So that means if the employer's loan was $100,000, and even if they used all the proceeds for allowable usage, they used it for to keep their payroll, but they only had 100 people during that covered period, you can see just prior to the pandemic, in February of 29th of 2020, and for that reference period in 2020, they only had 110 people for that period. So they actually reduced their workforce during that period. So they're only entitled to 91% of the loan of loan forgiveness. However, if they do bring those people back, so this is where it's important to know, are there 10 people that meet the exception requirement allowable for this calculation. So important to note there. Also, another place, there's 2 types of loan reduction forgiveness. As I mentioned, there's the FTE reduction, or there could be a reduction relative to salary and wages. And what this is, it's a dollar for dollar reduction if an employer reduced an employee's salary in excess of 25% of their salary or their hourly wage. And it's only applicable to employees that made more than $100,000. And it's a comparison between average salary in the first quarter of 2020, January 1st, 2020, compared to through March 31st, 2020, to the comparative period, the covered period, or the alternative covered payroll period. The other thing to note is you should not be calculating a reduction of salary to the extent that that person is representative of an FTE reduction. So, and a furloughed employee is a good example where you've reduced their salary to 0. You still continue to keep them on payroll for benefits, but they will actually be included within your FTE reduction and not the salary reduction. There's also a safe harbor exemption if you would reinstate their salaries prior to June 30th. So here I'm showing a couple different employees and a couple different scenarios. You can see for hourly and salary one, both employees during the covered period had a salary reduction or an hourly wage reduction, but there is no salary wage reduction relative to the forgiveness calculations. On each, for number two, you can see that there is also no salary reduction calculation because by June 30th, both employees, their hourly or their salary wages were reinstated to what they were in the first quarter of 2020. But the third employees of each, there is a wage reduction, and the calculation for both of those employees is different. So a salary employee, you're looking at the excess of 25%. So in this case, it's 21,000. So it's not the whole difference of the wage reduction. It's only the amount in excess of 25%. And you're taking 8 weeks of 52 weeks. That is your wage reduction. For the hourly employee, a little bit different. Still, the reduction is based on this $4.17, which is the excess of the 25% reduction. And you're multiplying that by the 30 hours that they averaged during the first quarter times the 8 weeks. So important to note, there's different circumstances and different calculations for a salary employee and an hourly employee. And just stepping back, and I mentioned this earlier, it's important that you're calculating these reductions and considering it on an employee by employee basis. So you could get the very different answers, and it's important to as you're maximizing this to look at it by an employee basis. There's a lot of documentation that's going to be required for your forgiveness application. It's bank statements. It's going to be third-party payroll provider reports, the tax forms that you're filing or you expect to file, like your 941s, your state quarterly business filings, canceled checks and account statements, documenting an employer contribution for health insurance or your retirement plan. On the payroll-related information, a lot of it's similar to what may have been required by the lender during your loan application period. On the FTE documentation, similar information is to be required to support the FTE calculation. The one thing there that they talk about is and identify is the covered period. The document submitted may be longer than the covered period. So they're not looking for exact dates. As you can see, in some of the guidance they've issued throughout this process, they've used March 1st as opposed to the February 15th date on some places. So keep that in mind as you're trying to look at what documentation is required. I'd also point out that while it's important, I think, for borrowers to look at the FTE reference period for both 19 and 20, you're only required to submit which one you select as your reference period. For non-payroll related items, it's amortization schedules of your mortgage interest. It's lender account statements. Interestingly enough, they've asked for both the covered period and the month after the covered period too. So keep that in mind as you're pulling together your information for non-payroll related items. It's the covered period, February of 2020, and the period after, the month after the covered period for business rents, lease payments, and utility payments. They're going to look for canceled checks. They're going to look for lessor account statements, similar information. A couple current developments, as I mentioned, there's a couple different bills currently in the House, they've passed the House, and they're currently in the Senate to be considered. The HEROES Act is a very broad act that includes relief and benefits for more than just the Paycheck Protection Program. A couple things that it does change for the Paycheck Protection Program is, instead of just profit organizations being 501c3s, it makes all 501c organizations available. So a lot of debate early on about 501c6s being not included in that Paycheck Protection Program as an eligible entity. Also, it specifically identifies an appropriation for employers with less than 10 employees. Importantly, the HEROES Act, it extends the 8 weeks. So much of what we've talked with clients as a task force group is, what if we don't use all the money for the 8-week period? What happens? It turns into a loan because some organizations are very much impacted by not being able to be open during the time period. So they're not incurring as many costs during the 8-week period as they typically did, which is what they got the loan for. And so this would extend that period to 24 weeks. So a good benefit for borrowers that are closed most likely because of state mandates at this point. Also, it extends the program to December 31st, 2020, as well as the exemption rehire dates and the salary reduction dates for the loan forgiveness reduction. It also, there's a clarification or maybe an error in the law where an allowable use for the loan proceeds is any debt obligation incurred prior to February 15th, 2020. However, that same item is not included in a forgivable loan amount, forgivable cost. So while you might be able to use the loan for it, you are not eligible for forgiveness if you use it for a instrument that is not a mortgage, like a line of credit. That is not a forgivable amount. Another item that is in the HEROES Act is the no limitation on the non-payroll and the payroll related costs. So that 25-75% rule is removed with the HEROES Act. Similar changes with the Paycheck Protection Program Flexibility Act. It extends, this though is only for, this only revises the PPP program. It also extends the covered period for 20 to 24 weeks. It includes a extension through December 31st, 2020. Includes a revision to the rehire exception. It revises the non-payroll limitation to 40% and requires a 60% payroll usage. It also, in the CARES Act, there's a deferral of employer payroll taxes. If you have a paycheck, if you applied for a Paycheck Protection Program loan, though, at the time the loan is forgiven, you are no longer eligible to do the deferral. So the Flexibility Act removes that exception and would allow you to continue to defer up to the date, which I believe is December 31st, 2020. So with that, I'm going to open it up to question and answers that I will see if I can.
So in the past, if everybody remembers, or if you're new, there is the chat function on the bottom of Zoom, or actually there's a Q&A button. Just press that if you have any questions, either of Chris, Brian, or Seubert. We will answer them. I want to remind everybody that this is recorded and it will be posted on our website. So if you missed anything, or you want to go back and look anything, or just as easily if you want to ask any of us to re-clarify or repeat, all of our contact information will be there as well. And I highly encourage everybody to reach out. So we'll see if we have any. Right now, I don't see any questions that have come in. I encourage everybody to, if there's anything that you have, please ask away. Brian, I'll start with asking a question, and you know, it's really hypothetical around how this is going to be treated, or how scrutinized it's going to be. But in your opinion, if in fact your calculation shows that you have 100% loan forgiveness, do you believe that they're going to honor that, or are they going to highly scrutinize that to where some aspect or portion becomes a loan?
So I think they're going to review the documentation much like they would, and I say they, it could be the lender, your bank, it could be the SBA on the back end after they look at it. I think they're going to look at your documentation and validate what you said in your application, and if you believe that you are eligible and entitled to full loan forgiveness, they're going to give you loan forgiveness for that amount. I think they'll scrutinize it, but they're going to try and be fair. So that's why it's important to kind of document, like when I talk about the FTE reduction and those exceptions, if there's people that resign from the company, documenting that they resigned and having that documentation on hand and available for the lender or the SBA to review at their request, it will be important, and that will provide you that very important loan forgiveness.
And then Brian, looks like we got some questions coming in. So the first one,
Telephone bill.
Yeah, it's a telephone
bill.
Yeah,
telephone bill is included. Yes, that's the utility. It's specifically in the law, in the IFRs, it says telephone bill. It's utilities are electricity, water, telephone, internet access is another one to make sure you're including. That is specifically identified within the law and the IFRs.
Okay, and then under the Q&A section, so we got questions coming in on both, but under the Q&A, we got 4 questions sitting there.
Okay.
Are you able to see those, Brian?
Yeah, I got them.
Okay.
So the one question is, for the FTE safe harbor, doesn't matter if you reduce the number of FTEs after April 26th, as long as it has been restored the number of employees by June 30th, am I eligible for the safe harbor? So if you have reduced your employees after April 26th, and during your covered period, you have less employees than you did in your reference period, if you bring them back by June 30th, you are eligible for the safe harbor.
How about the
Is there a way
one?
that I can know if I answered the question appropriately to their satisfaction, Brandon? If not, Brandon, you guys have, Seubert has my contact information. If I don't answer a question to your satisfaction, maybe I just didn't understand it, happy to have a conversation offline about, what your specific, what the specifics of the question were, and I'll happy to help you through that.
Okay. There is there's a couple following what you just asked. One is real easily, where do you find the loan forgiveness application, and what point toward the end of the loan period should this be submitted? Yeah,
so the loan application you can find it in a couple different places. It's either the Department of Treasury's website, it's on there. It's also on the SBA's website, sba.gov. I visit it every day, and you look for funding programs. There's a loan section. There's specifically Corona relief programs, and you'll see the Paycheck Protection Program. There's a list of all the IFRs, the loan forgiveness application. It's in there. It's a PDF. I'll say it is worth talking with your lender because they may have their own application too that they are looking to develop. But it's important to maybe look at so that you do know what information is required relative to loan forgiveness and the documentation associated with it. And the loan period that you should start submitting, if you are looking to do a safe harbor, there's no reason that I would foresee you to do the loan application for forgiveness any earlier than June 30th. There currently is no date that says you have to submit it by a certain period.
Awesome. How about the following one is pertains to union companies. So are union benefits to a local union considered payroll expenses? So
in the union benefits, I've fielded this question before. You know, you're paying a fringe benefit. It's prudent to look at, of that fringe benefit, what is eligible type of payroll cost and what is non-eligible. So that fringe benefit may be comprised of a couple different components. It might be their pension plan contribution. It might be their health insurance. It could include their monthly dues for the union hall. And if let's just say, for example, it's only those three items, that union hall due would not be an eligible forgivable cost based on the way the rules are written today. So we think it would be important to look at and understand what is comprised in there, because I think there will be a component that is an eligible payroll cost. And also importantly, is a eligible payroll cost not subject to the $100,000 limit too.
Okay, the next one basically says most entities believe pay on a bi-monthly basis payroll,
Yep.
basically 4 periods in 2 months. Will 8 weeks be treated as 2 months or literally 56 days as compared to 60 days?
Yeah, they're looking at 56 days. That's the way the application reads everywhere. And if you're bi-monthly, you're also not also maybe technically eligible for that alternative covered payroll. So important to note there, because although you're paying twice a month too, so maybe that was what their intention was, but it's really, is it semantics in how we interpret it. So we think right now it's 56 days versus 60 days. That just based on the way the application reads.
And then the last one, we did get positive feedback on your answer about the
Yep.
time frame for FTE, so that's great. The last one is that we have right now. Can you please review the slide on forgiveness, belief scenario 3 of the salary
Yep.
read?
Bear with me. So here, oh, I got everything open. All right, so here's scenario 3. You have a salaried employee in scenario 3 and an hourly employee in scenario 3. And those are that's the scenario where there is actually a wage reduction requirement. And here you can see they originally were making, prior to the pandemic, $80,000. And for whatever reason, maybe the salaried employee, maybe their hours were cut, right? And their salary was actually reduced to $39,000. And the rules are that a reduction greater than 25%, the loan forgiveness will be reduced. So in this case, you are allowed to reduce the employee's salary to $60,000. Anything more than that is going to reduce your forgiveness. And so in this case, of the annual salary, $21,000 is in excess of the 25%. You take the 21,000 divided by 52 weeks and multiply it by 8 weeks. So that is what, during that 8-week period, what was in excess of the $25,000 throughout that 8-week period. On the hourly side, it is similarly, their hourly wage was reduced during the covered period from $33.33 to the $20.83. And so the amount in excess of the 25% allowable is $4.17. The rules require you to take that $4.17, multiply it by the number of hours they typically worked in a week during the first quarter in 2020, and times that by the 8-week covered period. So that's where the $1,000 comes from the hourly wage for the hourly employee. So a little bit of a different calculation, but the theory of it is you have a decrease in excess of 25%. The amount that you didn't pay them in excess of 25% will reduce your forgiveness, even if you used all the loan proceeds for allowable usage.
Sorry, I was on mute. I believe that wraps up the questions. Again, if you have anything, we highly encourage you to reach either out to Seubert, Chris, or Brian. We'll help in any way that we can. I want to basically thank everybody for joining us. I want to talk about quickly going forward. We're gonna move these to once a month. We believe we covered most of the pertinent things through the challenging time. That has been kind of the forefront, or the major topics through this as it pertains to the insurance and the accounting and loans. So we're going to change it to once a month going forward. It will be on relevant topics going forward. We'll make sure that we have well in advance the topic that we're going to be covering. One of the things that we're waiting on is the bill that's sitting, was trying to pass by the House. Senate shut it down. That will address the COBRA and coverage of a COBRA going forward on the health benefits side. Obviously, we need to see what the Senate does before we can dive into that and what that really means for your business and your benefits coverage. So that most likely will be the next one. You're also going to be seeing a survey come out that's going to ask about any relevant topics that you want to see or hear about to better further steer and guide us to add value, and how these last 4 seminars have been. Again, these are recorded. If you want to go back to them, we're going to send out a link to it. Brian's contact information and Chris's contact information are going to be in there. If we haven't answered any questions, again, highly encourage you to reach out to us on that as well. Continue to check out our Facebook, our LinkedIn, our website for any updates. So we will continue to push updates on this. You'll either get it from your account executive, your sales leader, somebody within our organization, and it'll also be posted to the website, LinkedIn, and Facebook. All the social media outlets, any updates that we have, we will continue to do. We do know everything that we have talked about is up to date to today. Unfortunately, there are moving goalposts on all of these. So as the goalposts continue to move, we will get out that information, as I earlier stated. So again, everybody, we want to thank you for your time. Brian and Chris, great job. Really appreciate it. And we'll see everybody again in a couple weeks here.
Thank you.